Hi everyone, welcome to another conversation with VentureEdu. Today we have Dr. Anand Banka with us, who is a chartered accountant and an active investor in early stage ecosystem. So welcome Dr. Banka, and maybe you can introduce yourself to the audience.
Sure. Thank you so much. Like you said, I am a chartered accountant and doctorate in the sense PhD finance. I did my research in accounting and I specialize in accounting. I've written a few books on accounting and also regularly deliver sessions in India and abroad on this topic. But my heart lies in startups. So like you said, I actively invest in startups. I have my own portfolio of more than 50 startups in which I have invested, and I guide them, mentor them, take it forward. I also work with a lot of networks very closely, like Inflection Point Ventures (IPV), wherein I help them end to end from shortlisting, selecting the startups to taking them through the investment process, and even after that, handholding them through their growth journey. So that's about me.
Thanks. And accounting and startups, it's because it's the highest risk return category. So how did you get interested in startups?
So, you know, uh, when savings started happening, normally one would invest in either markets through mutual funds or direct equities. For me, it was difficult because I was not able to understand the market that well. I felt it is more driven by perception and less driven by the actual contents of the books from that company perspective. And that is where mismatch happened, wherein I expected some companies to grow because of their worth, but perception played differently. So unless you are in market for a very very long time, you will not be able to make money. So from that perspective, I wanted to deploy some funds, and startups in India started taking off. I'm talking about somewhere around 2016, 17, around that
Yeah.
time. It was a fad to invest in startups, and I also happened to invest in a couple of them at that point in time. And then I realized that startup is a world where the valuation is linked directly to how much you earn, revenues, EBITDAs. It is linked to your actual performance rather than perceived performance. And that is where I started liking this field. I started understanding it, and there was always kind of a kida to do business,
Hmm.
which I missed a lot because of your responsibility. Sometimes you want to earn a fixed salary across your life. You may not be that. Entrepreneurship is a different ball game. You may not be up for it, but then there's always that kida inside you to do something. So I thought, if I am not able to do, become a founder, I would rather help some founders in their journey and feel excited and feel I have achieved something in life. So yeah, that's where I started investing in startups.
Yeah, yeah. So what are you saying is that price discovery is better in private markets
Yes,
versus
yes,
public markets?
correct.
Okay. And how has the private early stage market evolved in India, let's say from 2016 to now 2025? What changes have you seen?
See, a lot of it, at a point in time, it was purely fad. Okay, people used to just, based on the industry you are in. So, suppose you are in a tech, people would just invest if you just say a tech. There was a time very recently, if you say that you are in crypto, people would, crypto platform or something related to crypto, people would invest. Then, after that, AI, if you're doing something in AI, people would invest. So this comes across more of a fad, but over a period of time, people have learned, at least the matured people who have spent good time in this startup space, have learned that this fad will not give you returns. What will give you returns is a mix of model, founder, and a lot of things around it. So I think this market has matured from both investor perspective. The founders have understood, what kind of investors they want and what are the steps. So a big growth I can see in the way people are investing and the way people are understanding startups. A lot of startups have now also gone for IPOs. You see these
Yeah.
recent trends of IPO and getting good valuation in IPOs. and hence VCs, Ps are getting exit, which was not the case way back in 2016, 17. These things, these number of IPOs of startups you would not see.
Hmm.
Okay, so all these things are helping everyone mature, the entire ecosystem mature in that sense.
Yeah. And also, earlier you mentioned about short term, long term, right?
Mm,
If you look at the journey of some of the startups which are going to IPO
mm,
now, it's a
mm.
good 10 to 15-year journey.
Correct,
It's not
correct,
like an overnight success.
correct, correct,
Most of them started right after the great financial crisis around that time, and they are
correct,
now becoming mature and getting listed,
correct, correct.
right? So you really need to have that 7 to 15-year mindset, anyways, if you're building
So
something.
you are right. In any asset class, you, if you want to really make money, you should have that patience of 10 to 15 years. However, what also happens is, like I was saying, perception driven valuation versus real value. And secondly, while it is not as liquid startup, but you would get a chance to exit every few years based on the rounds that keep happening, series A, B, C. Every round you will have some chance of exit. And I strongly believe that at each round, when you get an exit, you should exit partly. A portion of it you should keep exiting. You should not wait for, with your entire holding, you should not wait till the IPO happening. So you will keep getting your returns at every few intervals.
Hmm. And I think that's one of the challenges, right? Liquidity.
Hmm.
So many people, so many investors, especially HNIs, family offices, who are new to startups or
Hmm.
thinking about startups, they have this question, about exit, timelines, around liquidity. So I think a lot of them are still little apprehensive, and
Hmm.
rightly so, because traditionally they have only dealt in, let's say, public markets where liquidity is better and timing is not an issue.
Correct. Correct.
Yeah. So how should they think about it now? One is this partial path, which you mentioned.
Hmm.
But in case they want to participate in the ecosystem,
Hmm.
what role do you think they can play?
See, there are two things. Okay, one is every person or every entity should split their wealth into multiple asset class. There's real estate, there's gold, there's equity market, and there is this private equity or startups. Okay, and not everyone understands each asset class. Okay, so you may want to split the wealth in a way that put more wealth in the asset class you understand. So if there are a lot of friends I know who are HNIs or big investors who invest in real estates, only real estate, or a major portion of it is real estate. So if a investor only understands equity market, I would say that majority of their investment should go only into equity market. Don't try investing much into startup. You may try your hands, but don't go deeper into it unless you understand. So over a period of time, if you start understanding, very well, otherwise not. But like I started with, you should split your wealth. So that means you should have something in startup space as well. Even if you don't understand it, you should put something into it and then try and understand it over a period of time. Or go with some other, network firms. Like I said, Inflection Point Venture is one of them. There are quite a few in India today.
Correct.
So you can go through them, like if I don't understand equity market, I invest in mutual funds. Similarly, if I don't
Hmm.
understand startup markets, I can go through AIF and invest through those funds. So there are ways of doing it, but you should definitely split your wealth.
Hmm. So should you only get involved with startups where you understand their business model, or should you also participate as an investor
Hmm.
in startups? Let's say I don't understand, for example, somebody doesn't understand deep tech,
Hmm.
but they believe there is potential.
Hmm.
So should they go ahead and back that startup?
See, I'll tell you what I do. Okay, naturally no one will understand all spaces, right? These are varied spaces, ed tech, deep tech, varied spaces. Okay,
Yeah.
no one will understand all of it. But what I do is I identify SMEs of those sectors and I talk to them. I take their piece of their mind, as to what they think about this sector, what
Mm.
they look for. And then I use that to understand, what the startup is exactly doing. Secondly, it's also about understanding the founders. So I personally talk to founders and try and understand what kind of person they are and what they believe about this industry. And when I compare their belief with what the SME had said, you get this understanding whether this person understands, whether he's dedicated, whether he is enthused about that space or not, and accordingly you decide to invest.
So in a way, you do your own expert discussions.
Correct.
You summarize those findings, and then
Correct.
you compare versus the discussions you're having with the founder.
Correct.
Right.
Correct.
So founder is again an important part of the equation.
Absolutely.
Right. So please expand on that about the founder and how to evaluate, etc.
See, there are 2, 3 things I look for. Okay, one is how much the founder is dependent upon the startup success. Okay, what is the backing that person has? Also, in the sense that does he have net worth enough to survive if this startup takes 2, 3 years to kick off? Will he be able to survive on his net worth or not? Because sometimes what happens is, because of economic pressures, he might want to go get a job. He might not be able to sustain the startup for a long time. Okay, everyone has responsibilities. I will not blame him, but that's the nature of, that's how life happens. So how much he is dependent on the success? Does he have any side business or side things to do? If he has, that's a red signal. He has to put all into the startup, but should also have enough net worth or wealth to survive for another 2, 3 years without getting anything from the startup. Okay, because normally the founders don't get paid enough. They might be able to withdraw 50,000, a lakh per month, at least in the early stages. Sometimes not even able to withdraw because cash is not there.
Yeah.
So how will you take care of your wife, kids, all your expenses and all that stuff? So you have to have that much. Second, how much the startup is ready to learn. A lot of founders, they think that they know everything. Okay, that is again a red signal for me. While he should be confident that he knows, but he should also be open to learn. Okay, while I may not be an expert in his sector, but because I have invested in so many startups, because I have interacted with so many founders, I look at almost like 100 decks every month, and then select a few to take it forward. So I've seen so many things. I might not be expert in his field, but I have seen so much around it that I might be able to add something, maybe small things. And if he's not ready to learn from it, then I may not be able to interact with him that well. So how much he's open to learn. And third is how much expertise he has in the sector he has selected. So I'll repeat, he should be financially stable, he should be open to learning, and he should be expert in his segment. These are the 3 main things I look for.
And how do you judge for that expertise?
Again, like I said, there are SMEs for each sector available, right? You can talk to them, you can reach out to them today with LinkedIn and a lot of social media. You get friends of friends. There are a lot of groups or networks which are on WhatsApp, wherein you can find out, say, a competitor or someone with working in a very large corporate, but who is into this similar segment. You can talk to them and understand what is this industry looking for, what kind of products, what kind of market, what kind of growth, all that you can understand.
Right.
And then when you talk to founder and take his views about it, you will be able to understand whether he knows it or not.
Yeah. And I think all this will require spending a lot of time with the founder.
Absolutely.
Because it's 3-4 hours. You can't really judge growth mindset. You can't really judge whether they go deep into a
Correct.
certain topic.
Correct.
So probably it is like interaction over 2, 3, 4 months where you have had some exchanges, you have given some inputs, right?
So you're right. See, there are 2 modes of investment that I do. One is through these networks. When I do through these networks, a lot of work would have already been done by these networks. Okay,
Okay.
like their team, they would have their team doing a lot of research. You can simply ask for that work which they have done and go through it, and you will be able to make up your mind.
Right.
Okay, and then there is other set of investments which I have done directly without any of these networks coming in. For those investments, yes, I have spent some 2, 3 months, 4 months with the founder, looking at their websites, looking at their products, looking at their talking to their customers, vendors, SMEs, a lot of them, and then I decide to invest. So I do a lot of research when I directly invest in a startup.
Yeah. Because recently I was just having a conversation with a fund
Hmm.
manager,
Hmm.
and we were having this conversation. Why is this like a 3-4 month period which you
Hmm.
keep? So he gave me this insight that I'm actually watching them,
Hmm.
because the first meeting, what did they tell me? And the second meeting, I'm
Correct.
asking question maybe in different way and trying to triangulate that what did they do in last 30 days,
Correct.
right?
Correct.
So it also gives me some insights into the execution bandwidth, how the team dynamics are,
Correct.
etc., etc. Because otherwise, it's very difficult to evaluate 4 to 6 hours
Correct.
whether to put money or not,
Correct.
right? Right.
Correct. Correct.
And I would say in last 10 years, it has also become mainstream,
Hmm.
right? Because at least when I was in college, or I started my college around 2006
Hmm.
7, it was not mainstream,
Hmm.
right? It was
Right.
very rare to see, let's say, a graduate or a MBA student or somebody dropping out of college
Hmm.
to do a startup, right? And I think that has also sort of influenced a lot of other people to jump into the ecosystem,
Correct.
right?
Correct.
So how do you look at that, that it has become mainstream, so finding quality founders also becomes a challenge sometimes.
Hmm. Hmm. See, again, I go to a lot of colleges nowadays because all these colleges have this event for startups. Okay,
Yes.
wherein you go in either as judge or investor or in some form you go and talk to a lot of students.
Right.
Okay, so one, I believe for India's growth, this is a must because any innovation today happens largely in startups, and very few innovations actually happen in large corporates. They are well set, well settled, very less flexibility compared to a startup where the founder knows that unless he invents something, he will not be able to survive. Okay, so the startup starts with an invention, whereas for the large corporate, they need to get stuck somewhere to invent something new. Otherwise, their life is on. Okay,
Mm.
so this new invention, which will take India forward, will only come from the startups. Secondly, the dependence on job is going down because of the startup world, because the founders are entrepreneurs paying themselves and creating more jobs. So a lot of dependence on these corporates for jobs is going down. Third, if you see the way life has become more convenient 10 years ago and today, small things like ordering small grocery items also today comes into your house within 10 minutes. See the level of convenience that has only happened because of startups.
And on the
Okay,
other spectrum, agri-tech and everything,
everywhere,
bottom and the
everywhere,
top both.
everywhere,
Yeah.
everywhere, in all fields. This was just an example.
Fintech also, right?
Everywhere, yes,
Yeah.
fintechs.
Yeah.
Banks used to never fund any
Correct.
of these,
Correct.
so NBFCs, fintechs, all of them have created complete change in the way India works. In
Right.
fact, the world works, but a big change in India as well. India, you can see impact further because India was far behind. So the impact can be seen much more because of this. So this is a must have today. Okay. If more people are getting into it, yes, things are becoming difficult, challenging, which is further better for the country. The more challenging it becomes, the more invention will happens. It's all for good, I would say. Yes, a few people will struggle at the start because they will not be able to find foot and maybe end up with a job. A lot of founders, which I've seen, even friends and startups, where they failed and went back to job, which is fine. But they would have learned so much in their failure journey that they would perform much better in their jobs. So I would say even this failure is giving them success.
Yeah.
So the way this is shaping up, I think this is all for good. If you're spoiled for choice, it is all for good. If you have so many founders to look at, if you have so many startups to look at to select where to invest, not to invest, it is all for good.
Do you think we need to celebrate or respect failure a lot more as a culture? Because currently, I feel, if I compare
Hmm.
early stage ecosystem in, let's say, Western countries,
Hmm.
for example, US
Hmm.
or China
Hmm.
in Asia Pacific, there, I think in the US, I spent 4 or 5 years in the
Hmm.
US. Failure is not a problem.
Correct.
right?
Correct.
Actually, they get better jobs when they go
Correct.
back to the corporate market, and larger companies absorb them, welcome them,
Correct.
because they will bring new things to the table, right?
Correct.
In India, I still feel that maturity will take some more time, maybe a decade, or I don't know what the number of
Hmm.
years is
Hmm.
required. But I think as a culture, we could do more around that.
I agree. See, I've seen an ad recently of a large corporate wherein they were looking for leaders, and there the ad said they were looking for failed entrepreneurs as leaders, or someone with business background, someone with maybe family business or some business background. They were looking specifically for them as leaders. That means they were not looking for leaders in the traditional manner who have grown in corporates and gone up to the level of CEOs, CXOs, or whatever. So that means, yes, it's very slow. It's in pockets, very few pockets maybe today. A lot of acceptance has to come in. But the way in which people are failing today in startups, I think we are not very far away from this acceptance because, very few people fail. People will not accept. If people will fail in volume, you will have no choice but to accept.
Right, right. And what do you think are the changes on the investor side? Because I remember in 2018-19, there were roughly 35, 36 AIFs in India.
Hmm.
Currently, there are 140 plus or some number like that.
Hmm.
So it has gone maybe 3x, 4x. If I go back 2006-7, when I started tracking
Hmm.
markets, it was just few. I could count on
Yeah,
my fingers how many
correct,
AIFs are there.
correct, correct.
So talk about the investor side also. How has that evolved?
See, a lot of networks today have started democratizing investments with investing as low as say 50,000 rupees in a startup. Okay, through these funds in a way, while they have to commit for 25 lakhs in 5 years. But SEBI was not so strict until a few months back. Investors were required to only give a self declaration that they have net worth enough to invest or they have income enough to invest. No one used to check or verify those documents. It was based on self declaration. If I tell you that I have this, write and sign it off.
Yeah.
In India, people don't value signatures as much, their own signatures somehow. So very loosely people would sign off and give you declaration, you would accept it, and I would be able to invest as low as 50,000 rupees. And then I fail, and then I go back. So I try for 50,000, 1 lakh rupees. So in a way, it helped people understand whether I understand angel investing or not at a cost of as low as 50,000 rupees.
Mm.
I need not invest 5 lakh, 10 lakh, 50 lakhs to learn that lesson. Okay, so in a way, it was good. But the other side of it is a lot of investors who are not having that income or wealth and not having understanding of startups burned their hands in a bad manner. So, all this, when it came to light, SEBI has now come up with new regulations wherein small time investors cannot invest in such very high risk products like investing in startups. So they now need you go to SEBI and get accreditation. Only then you can invest. So if I am already an AIF investor, I can continue investing in that AIF. But if I am not an AIF investor today, okay, in that specific AIF, I cannot become an investor in that specific AIF unless I go and get accreditation. Okay, so new investors today are not able to come in unless they go and get that accreditation. That accreditation you will only get if you have that net worth. So for individuals, it expects you to have income of say around 5 crores and a net worth of 1 crore, both, or a net worth of 2 crores if you are not able to justify your income through your ITR and all, as high as 5 crore income per annum. And it will not include your residential property. Only then you will get accreditation. So that means all these small time investors will now not be able to invest in startups through AIF at least. They might be able to convince the founders and directly invest on cap table. There you do not need any SEBI approvals, but not through AIFs, not through structured manner.
And what do you think will be the implications?
So there is a lot of negative implication on startups, because today they were easily able to get, like, if I get a lot of 50,000, 1 lakh, 2 lakh investors, I will be able
Yeah.
to make up that 2 crore which I need. Okay. But if these investors will not be allowed to invest,
Mm.
okay, I will have to go to large investors to invest that 2 crores. Today, if I ask you how many people would have income of more than 5 crores per annum
Wow.
for individuals, okay, or net worth of more than 2 crores excluding the house in which they live, very few. Okay. If I ask you how many corporates who are willing to invest in startups, firstly, corporates generally are not so, unless they have their own separate, entity for investments.
Accelerator or something like that.
Ha, ha. So these corporates require a net worth of 10 crores. Okay, again, a very difficult task. So that means I would say, amongst the current investors, forget the population of the country, amongst the current investors, I believe 90% of the investors will not be able to invest any further in terms of volume, in terms of number of investors. 90% investors will not be able to invest further. Now, these 90% investors consisted, like, in my understanding, around 20-25% of the funds that they get in, because these were small time investors. Large investors would continue. But the smaller startups used to run only because of these small time investors. No big investor would invest in early stage startups, or they not used to.
Yeah.
So then, where will these early stage startups go? They will not be able to get such, funds through AIFs and such structured money. And generally, in my understanding, startup needs two things. One is investment money, but also will need networking. Okay, these
Mm.
networking will come from networks or will come from structured funds,
Yeah.
not through angels. Okay, so I think in next couple of years you will see a lot of startups failing, or not getting money. While SEBI is trying to protect the investors, this will negatively affect the startups.
Right. And do you think this option of going through a SPV or a LLP or a limited partnership, that is still open or no?
So yes, LLPs are still open. Okay, all other modes of investment which is not through AIFs are still open, but these are highly risky. See, if I invest through a LLP, suppose you and I together
Yeah.
come
Yeah.
form an LLP and invest. Okay, we both will have to agree if I want to exit. Okay, today what happens is, if I want to exit, I can simply sell my units. Okay, I can transfer my units to someone, or the AIF would take a voting, and based on voting it will decide to exit, or maybe the fund manager of that AIF will decide to exit. So it's a structured format of doing it. In LLP, there is no fund manager, professional fund manager. Okay, you and I might have fights, then we will not be able to come at a decision. There is no professional management of the way this will be managed. Okay, and if suppose some fund house wants to create such LLPs and have appoint a fund manager and professionally manage LLPs, okay, that is possible to an extent. But again, because there is no clear laws around, so AIFs are monitored, right? These
Right.
are properly regulated. There cannot be any cheating, to a lot of extent cannot
A lot
happen.
of compliance work.
Lot of compliance work. Okay, you get regular statements.
Yeah.
Okay, you are trusting all these AIFs. I think the trust factor would be missing in these LLPs.
And then say we can wake up any day and put a
Correct,
question mark,
correct,
right?
correct, correct,
If they
correct.
realize that so much money is being channeled through these SPVs.
Absolutely. So that risk will always be there. Regulatory risk will always be there.
Right, right, right. So that is not good for early stage companies, I guess.
So I would say angel investors investing through LLP is a high risk. So you are already investing in a high risk category, and then you are investing through a high risk vehicle. So then you are doubling up your risk. I
Another
would
layer
not
of
suggest
risk.
that.
Yeah,
Yeah.
yeah, yeah, yeah. And what do you think are the good signs which you have seen over last 8-10 years on the investor side? How has it evolved in a good way?
See, like you said, a lot of AIFs have come in. So a
Yeah.
lot of VCs have come in, a lot of PEs have come in. So this entire ecosystem has evolved, right?
Yeah.
So a few years back, there were very few VCs and very few PEs. Today also PEs are very few only. There are a lot of
Yes.
VCs, but very few PEs. A few years back, it was further low.
Yes.
VCs were also very less, PEs were further less. Okay. So more number of VCs coming in will give exits to angels. More number of PEs coming in will give exits to VCs. And these IPOs happening, then PEs are also getting exits. So I think this entire positivity has been created across this startup investing from an investor perspective. So today I'm not scared to invest in a startup if I like something, because I know that there's a way it can get exit.
Yeah. So for the audience knowledge, I used to cover PE in India in 2011.
Huh.
Total deployment annual VC plus PE combined was around 17 billion at
Huh.
that time. Today, if I talk about only VC is
Hmm.
3 billion per quarter.
Wow. See.
So
Nice.
and then PE is, I'm not including that. So
Correct.
that's
Huh.
how the whole ecosystem has evolved. So VC also, there are a lot of funds which are there, but they are not really active.
Hmm.
What we call zombie funds.
Correct.
They have done one or two deals, but they are not able to raise further money from the LPs. So
Correct.
there are a lot of vehicles which are there in that limbo.
Hmm.
So that number is probably going to go down further. It may come down to 100 from 140 in next 2-3 years.
Correct. But these will be active 100.
Active
Huh.
100. Yeah.
So they'll cover up for that 40 in terms of the volume of money they are able to raise and invest.
Right. And then also what has changed is that 15 years back, a lot of LP, 80-90% was money was coming from outside India.
Hmm. Hmm. Hmm.
There were no domestic LP ecosystem.
Correct. Correct.
Everybody was just sitting on the fences. They were not sure whether we should deploy with these fund managers.
Hmm.
There were no corporate money which was flowing into the funds as LPs. Now I see on the consumer side, majority of the money which is going to top 2-3 consumer funds is coming from
Indian
Indian
investors.
entities,
Correct.
and they are able to commit hundreds and crores of money.
Correct. Correct.
And then eventually also pick up some of the startups which are funded.
Correct.
Right?
And look at the number of accelerators. At
Hmm.
one point in time, we used to only hear accelerators like Y Combinator or some of the
Yeah.
international ones. In India, you could not find any accelerators from that perspective. Today, you would find almost every college housing at least 20, 30, 50 startups. Every university housing hundreds of startups.
Yeah.
So accelerating their journey in a way by giving them all the guidance, giving them space to work, finding like-minded people, students. So in a way, the entire ecosystem has evolved or shot up like anything in last few years.
Yeah. So in sports psychology, there is this term of ignition. When
Hmm.
you see someone performing really well, you also get inspired that I can also do it.
Correct.
Right.
Correct.
Usually coaches use it. And then the whole spiral effect
Correct.
happens within the team. And you mentioned that you interact with a lot of college students. So let's say outside the institute of national importance,
Hmm.
how have been your interactions with colleges in tier 2 towns, tier
Hmm.
3, tier 4, and what are your learnings from those interactions?
See, one is almost all colleges now, have some kind of program, some kind of push for startups, because they have seen that once these startups become big, these colleges' names also, gets a lot of attention. Even in tier 2, tier 3, when some founder from those colleges go ahead, create startups, and that becomes big, there's always some tagging towards your alma mater going back to the college that influences all other students who are there in the college, plus also all the incoming students or proposed students will get to the next curriculum, will join that college, because from that college has encouraged the past students to become big in terms of startup.
Yeah.
So these colleges have started setting up these things. I have seen private colleges having proper machines for these startups to learn from. So, for example, some robots, or if you need big servers, so a lot of facilities have been provided to them. in terms of infra and all, so that you can grow. You
Yeah.
can do your research, you can do inventions, you can grow. You get a lot of guidance also. There are specialized faculties in those colleges to make this happen. Okay. Now there are two parts to it. One, this is a good start, okay,
Hmm.
to it. But then after they reach a particular point, which is also very early in their life, from that perspective, the startup life, from that perspective, they need some advanced handholding, some advanced knowledge, which the college will not be able to do. So today I find colleges are getting active in this space, but beyond the point they are not able to help the startup. Okay, for multiple reasons. One, these colleges do not have expertise in how funding is raised. Okay, they are specialized, say engineering college, so they will only know something about science and engineering. They would not know much about finance side of things.
Hmm.
Okay, then they would not have that kind of network at a larger level. They would have network within the college or multiple colleges, but they would not have within corporates or within other fund houses and all that stuff. So the hand holding that a startup needs after getting out of that college is currently not there. I feel a lot of it is missing. Some of it is being given by these networks,
Yeah.
the angel networks, but a lot of it is not there. When I talk to these startups, they understand their business. They know where they are going, or where they want to go. Okay, but how to go is missing. So I think that space is something where a lot of work needs to be done. I understand VentureEdu is trying to get into that space, but a lot of things need to be done. A lot of work needs to be done in that space today.
And what do you think can be done? What are some of the things which where we need to improve?
See, like I said, the founder understands the business. Okay,
Correct.
but what they do not understand is how to monetize their ideas. What kind of models are available? Do I give it on subscription? Do I give it on pay per use? What is the benefit of subscription versus pay per use? As example, I'm saying.
Yeah.
So
Yeah.
there can
Yeah.
be a lot of revenue models, right?
Yeah. Yeah. Yeah.
What model will work? What will not? Okay. Second is marketing. Lot of these founders would come from technical engineering or some kind of background, may not have marketing background. Okay, so one is you give it to an agency. If you are well funded or deep pocketed founder, you might spend through marketing agencies.
Yeah.
But most of these founders are not. Okay, they are not well funded or they are not deep pocketed. So they go on Google, YouTube's, learn how to do marketing through these channels, but these are not professional way of doing things, right? If someone handholds them, teach them how to do marketing, what are different terminologies, what are different techniques, SEOs and all that stuff, how to do those things. That is also important. Third is getting connections with these platforms. Suppose I want to sell on Amazon or some of these platforms. How to sell, how to market there. Again,
Yeah.
so these are from business perspective. Second is from investor perspective. How to get networks? Should I raise money from angel? Should I raise money from VC? At what point in time I should raise money? Should I stop raising money? People are ready to fund me. My idea is so great. People are ready to fund me. Should I keep raising? Should I stop raising? I don't need that much money today, but I've received the money. Where do I park it? Okay, what information do I give to investors? In what format I do give to investors? At what periodicity do I give to investors? How much of demands of investors should I entertain? Demand, request, whatever you want to call it.
Yeah.
How much I should block, that beyond this I will not give you more information or more demands or more requests. If I'm raising fund, what is the correct percentage I should offer to the networks or person who is helping me syndicate funds? How much is the right percentage? So there's so many questions these startups have, these founders have, that unless they have some holding hands, some mentor, some guidance, they will not go in the right direction. With the right mix also, the right founder mix, right business idea mix, but still they will not be able to succeed unless there are people around them or there are institutes around them who can guide them on these aspects, hold their hands and take them to that space.
Yeah. So overall, this commercial aspect is missing. Commercialization mindset is not there.
Correct.
So when
Correct.
I interact with them, they're treating it like a college project,
Huh.
while it is not a college project,
Correct.
right?
Correct.
Because the real market, as you know, real customers are not kind.
Correct.
They are giving you their hard-earned money, so
Hmm.
they demand certain level of product, certain level of service.
Correct.
So that commercialization and that seriousness, I think that takes
Correct.
some time. And even if you look at global accelerators, right? Let's take, you mentioned Y Combinator.
Hmm.
For younger founders, when they are funding them, giving them 500K, usually between that and Series A, there is a 4 to 5 year gap.
Absolutely.
And that is because there is certain level of maturity required to be able to manage, build teams,
Correct.
go to Series A VCs,
Correct.
build your narrative, and defend that.
Correct.
Right. So that's again a 4 to 5 year journey. And I think in Indian ecosystem, it's same. Usually after a seed, pre-seed, there is a 3 to 5 year gap where young founders need to sort out a lot of things at the back end.
Correct. Correct.
It is not that the idea is not working. It's just that investors are also evaluating how
And
you're
they don't know
progressing.
everything, right?
Yeah.
They can't be expected to know everything.
Correct.
So where do they learn from? Colleges, schools would teach them certain things, not everything.
Right. And now I think one of the things which I have realized is that a lot of focus is on fundraising, right? Versus, let's say, if I'm going to build something, I would like young people to spend a lot of time in selecting that idea. Whether this idea is a good match for my personality, my journey,
Correct.
would I enjoy it 5 years from now?
Correct.
Simple. Versus, okay, what is something which can be funded right now? What is the cycle and what is selling in the market? And then also, sometimes they also get influenced without even reflecting on it, that whether this is my path or not.
Very interestingly, because there is no one to help them decide on the idea. They might have this idea, whether, like you rightly pointed out, whether this idea will keep me interested 5 years later or not, whether this idea is large enough to become a $1 billion ideas or not. Because they are not able to decide, what they do is they go to investor, and if an investor is able to invest, that means there is something in that idea. So they try and buy the acceptance, in a way, that testing whether their idea would become successful or not is if I am able to convince an investor to invest. But that is not the ideal way to do it, right? I mean, that's a way they have found or created in India. Like we say ki, we create ways of doing things.
Yeah. So that validation should come from customer, not investor.
Correct. And it should be professionally, scientifically validated rather than an investor investing becomes a validation. I think that scientific validation is missing.
And I think that's the seriousness which I see on campus incubators and accelerators.
Correct.
They have helped in building that awareness. But the chances of, if I look at, let's say, some of the top on campus accelerators in India, there are exceptions like IIT Madras and few other campuses where we have really seen some, good ideas scaling. Otherwise, very difficult to single out, okay, this is what has been incubated, this has become commercial. A lot
I
of
agree.
accelerators are like that. And there are, I think, around 2000 incubators / accelerators, which the list I was checking, even more than that.
Correct.
The list could be bigger, including educational institution and other institution. So I think this directionally we are on the right track, but I think a lot of work still needs to be done, right? Now, what are some of the negatives when you are meeting a founder, let's say as part of a network, or let's say you are evaluating a founder as an individual investors? Then what are some of the red flags which you see? You mentioned three things. The subject matter expertise. They should have that financial runway, right?
Correct.
Etc. Etc. But besides that, what are the other personality traits which you look for or which you think? And growth mindset you already mentioned. And besides that, what else you think is useful?
I'll tell you a few instances without naming any startup or details of it, but we'll give you an idea. Like I was evaluating a startup which had earlier raised some funds, some small funds.
Okay.
And what they did was they invested that fund in real estate. Now that gives me a big red signal. Okay, that investors have not given you money to invest in real estate. You might have, found a way to park that money for some time by, maybe developer is your friend or whatever, but you can't divert my funds. That funds is for your business, not for diversion into some investments. Okay, you can park it in FDs, you can park it in some reliable, uh, things, but not such investments in real estates and all. So that tells me that founder, has some is not very clear from that perspective. One example. Second example, if you see, a lot of founders don't have ability to listen to you. Okay, when you talk to them, they're stuck onto one point, and I believe this is correct. They're stuck onto their point. They're not ready to listen to you on a lot of points. Like if you ask them, have they researched onto markets? Okay, and you start questioning them on markets, they will not have that in-depth knowledge of market. That is again a very big red signal, that if they don't understand their markets, if they don't understand the competition, they just know their product. I think more than your product, you have to understand the competition first, the market first. If you don't have that understanding, it will be very difficult to succeed. One example I can give is recently talking to a founder who is into clothing. Okay, I gave him a couple of partnership ideas. Okay, he came up with a lot of data, research data, that why this partnerships is not currently for him. It may not make sense for him.
Yeah, yeah.
I like such founders. Okay, you listen to the idea, you do research, you come up with data points, and then you present. That means you are hardworking, you understand the market, or if you don't, you are ready to learn and ready to do research. So there are softer points which tell you whether a founder is, good or not. I like-minded founders. I like founders who are soft, who are ready to learn, who are respectful to you. Those things are very necessary, and who do not have any mindset of doing cheating in small ways. So it comes out small. If you try doing cheating on your balance sheet, if you try doing cheating on your tax, if you try doing cheating on your investments, anyway, any of these smaller points, it means, that filter, the honesty filter, is somewhere not very strong, and I would not like to work with such founders.
Hmm.
So when you talk to the founders, you will get all these ideas, what they're doing, what is their family, what is their growth story, where they have come from, where they have studied. All of it will tell you how strong they are on their business sense, whether you call it honesty, whether you call it respect towards others, how do they treat their employees. All of this you will get an idea, and together their nature will tell you whether you can work with them or not.
Hmm. And when you are investing outside the networks, do you generally build a theme, a thesis, or do you just do bottom up, whatever is coming your way, you keep evaluating, etc., etc.?
So currently, it is whatever comes my way, I keep evaluating. I have not created a theme, and I don't approach the startups according to the theme, while that would be ideal way to do it. But currently, because I am not, full time into investing,
Correct.
I am not able to give that time. So whatever comes my way, I evaluate only them.
Yeah. Do you find any sectors interesting at this moment?
So I feel, a lot of sectors which have taken a beating in the past are now coming up well. For example, edtech. If you find a recent edtech startup, okay, that means they have learned from the mistakes. So now they will do well. If you find a fintech, okay, which has come recently, because there were a lot of fintechs in the past, and then RBI created a lot of regulations around them,
Yeah.
and then they started taking NBFC licenses. A lot of fintechs were doling out personal loans or EV loans, and all, have seen failures. And if someone is now learning from their failures, creating a model today which is learned from those failures, then they will succeed in much better way. So I try to find such founders who have closely studied failures in that segment, an industry which has seen failures, founders which have learned from those failures and created their model to mitigate those failures. That kind of startup attracts me you know. So you can see, like I said, fintechs, edtechs, these have seen a lot of failures. So these are two which attract me today.
B2B SaaS.
B2B SaaS, you're right. Yes.
Yeah. And I think consumer e-commerce.
E-commerce, and again, like there are a lot of them. AI
Yeah, yeah.
utility also. The way people used to use AI
Yeah.
in their startups. Okay. A lot of them have learned now how to use AI in the proper way, how to make it a utility rather than just claiming AI. So even that attracts me.
Hmm.
If you're able to really use it and make it a utility for the consumer.
Right. And accounting is your topic.
Yes.
And as an undergrad in finance, I used to dread accounting. But when I started my career in investment research, accounting was the thing to learn in the
Hmm.
first 2-3 years, because you can't read financial statements without
Correct.
learning about accounting.
Correct.
And you can't write a research note because ChatGPT was not there. And a lot of it was probably 3-4 levels of review going back and forth. And your managers will point out commas, full stops, and what
Correct.
word you have used, and why you are recommending this or not recommending this. So talk to me about accounting. Why should we care about accounting? I mean, young founders as well as let's say investors, both.
So I'll give you three examples, only three examples, maybe to make it simpler to understand things. And these are all three practically seen, and startups getting affected because of which. And then they have realized the importance of accounting. Okay. One common example is the CCPS kind of instruments. Okay.
Yes.
Which is very common. Every startup would have issued CCPS. Okay. And there are very critical terms in that CCPS to decide whether it will be classified as equity, which is shareholders' funds, or borrowings. Okay. And unless you understand that finer terms, today you might account it as equity because you're a small startup. But once VC money comes in, or you go to, P level, that time you will have to have a good auditor, a good accounting firm. They will check your books, everything.
Yeah.
And if that time this equity gets classified as liability, there is reaction from investors. There is reaction from bankers. Bankers will not like to fund if your debt equity ratio is lopsided. A lot of other implications like interest expense going to P&L, whereas previously it was charged to equity because it was classified as equity.
Yeah.
So your net worth getting wiped off once such instruments are getting classified as liabilities. So a lot of implication is there on that startup, which today they may not realize. When the money is coming in, they'll sign off on any CCPS terms and agreements. They would largely look only from the business perspective. The rights that the founder is getting, the rights that the investors are getting, they look at those aspects, but they will not look at those finer terms of how accounting looks at these instruments. Okay, and then they have suffered. Okay. Then they go back to the investor, ask for modification. Some of the educated investors will agree for such modification of the terms because it is important for the startup to grow.
Correct.
But some may not. So I've seen startups getting suffered, and a lot of startups having government contracts, which where government has a criteria of looking at net worths.
Yes.
So if your net worth goes down, you may not get government contracts, and then you're one fine day without any contracts. So that is one example. Another example is revenue. A lot of startups, they don't understand the accounting terminology. So revenue for them is what money they receive from customer. Okay. I was talking to a startup a few years back, okay, wherein it was offering battery swapping services, for which it was selling a station kind of thing, ATM kind of thing, wherein batteries are kept. You
Yeah.
can come, you can swap the battery there and go away. Okay. Suppose you are interested in lending, leasing out the area. You have a house, and there is some area around that house which you own, and you are okay to keep my station in that area, and it is accessible from road for public. So any driver can come in and use that, and for that you will earn extra money. Okay.
Yeah.
Now that startup was accounting two kinds of revenue. One was selling that station to you, and the other is swapping. Every time swap happens, he earns. Now, when I saw from accounting perspective, I explained to him that the accounting that he's doing is not correct, because you are not interested in buying his station, right? You are interested in earning the rental for that space that you are leasing out to that startup.
Yeah.
So for you, it cannot be purchase of that machine. You cannot do anything with that machine. Tomorrow you cannot sell it, scrap it, do anything with it. No decision you can take on that machine. All decision is that startups. You're only kind of leasing that space, and he's able to keep that machine in that space. But he was recording a revenue as if he has sold that to you. 2 years later, I spoke to him. I was assessing for his next round. And then he changed his entire revenue. He accepted his mistake. He must have realized after talking to some of the investors and all. And he had to change his entire revenue recognition. His significant revenue stopped coming in on immediate basis. It was then deferred as leasing over a period of time.
Yeah.
Okay. So again, your revenue looks significant to start with, and then keeps falling down because you did not record the revenue in previous years correctly. Now
Yeah.
this happened with a lot of edtech companies also. When they were giving courses, they were trying to recognize all of the monies upfront. If you have paid me money for a course, it might be a yearly course. I might be giving you some of the books or online courses and all that stuff, recorded, live, books, all of that was bundled together. As soon as you paid me for the course, I would record revenue. But that is not the right way of doing accounting. Again, they had to change the revenue recognition profile. The entire profile changed.
Yeah.
As soon as they grew and went to some educated investor or VC or above, they had to change their practice, and again taking a hit on revenue. So creating your model, structuring your contracts with your customers, your vendors in a way that you are able to achieve what you want to achieve. For that, you need to understand accounting or hire someone who understands accounting and take proper consultation from that perspective.
Yeah.
And
And we also see this simple things like inflating numbers by not accounting for taxes,
correct,
GST, 20-30% inflation, 10% TDS,
correct.
18% GST.
Compliance is,
Yeah,
yeah,
yeah. So some 28% though, that difference is already there, because
correct,
when we actually get down to numbers, then we see, okay, actually this is much lower.
correct,
Yeah.
correct. GST is recorded in revenue.
Yeah.
So your top line is inflated, your expenses are inflated.
Yeah.
So a lot of examples. So one more example is on the positive side. Basically, these startups do not know what they can capitalize, what they cannot.
Yes.
And a lot of the times, either they capitalize the wrong items or they do not capitalize the right items, which they could have capitalized. And because of which they have shown loss in their PNL. Now, what happens is banks do not want to fund loss making startups. They want to fund startups but not loss making startups, whereas there's a whole lot of startups who are loss making, but they won't get bank money because they're loss making. Now, had they done the right accounting or structured their expenses in a way that they are able to identify what can be capitalized, what cannot be, and because of capitalization, they could probably have turned profitable from P&L perspective. Cash they will still burn.
Yes.
So from investor perspective, I will look at how much cash they are burning and what is their PNL. But from bank perspective, they largely look at your PNL. So if you are able to do the right accounting and present the right profitability to the banks, you will get access to those banking funds also. So I think accounting plays a critical role in how you manage your startups. Like there are a lot of aspects, accounting is one of them, but is critical aspect. You cannot ignore and move on.
Yeah. And somehow this financialization, right? I see when I interact with younger students and even
Mm.
founders, they are so enamored with the financial world. But finance itself is not a subject.
Correct.
It is accounting plus economics plus arithmetics plus statistics,
Correct. Correct.
right? All four things, and
Correct.
then much more.
Correct.
Maybe a little bit of psychology as well into that if you go to the
Mm.
trading side.
Correct.
And but people somehow overlook accounting, right? So that's always intriguing to me, that how can you write a language without knowing the script? right? So anyways, I learned this probably 2 3 years into my career, and then I spent as much time as I could on gap and
Hmm.
IFRS, and even some of the global transactions I got to study a little bit. But yeah, I always find it very intriguing, accounting. So as a young professional or a young founder, what can you do to improve your accounting skills?
I think there are a lot of courses which you can attend, but more importantly, I think accounting is an art. Okay, you have to understand the logics of accounting, the principles of accounting, not the rules of accounting, but the essence of accounting. Okay, so while you can attend some of the courses, but try understanding the essence or principles of it and not as rules. Okay, then you will be able to reach the right, where you want to, at least you will have basics of accounting right.
Yeah.
Like I was saying, what can be capitalized, what cannot be, how to present revenue. At least if you understand the transaction, see, people understand the transaction, right? The battery example that I was giving of the founder, I don't think he had any misconception that he's selling the machines, because no one wants to buy that machine, right? What will I do with that machine? He understood that.
Yeah, yeah.
And similarly, the educational courses I was talking about, okay, they understand that they have to incur cost across the year, throughout the year. How can they record revenue on day one and incur the cost across the year? That is basics, right? That you will have to match revenue and expenses.
Yeah.
So if you understand the essence of accounting, I don't think you need to go deeper, and there you can hire help. You can get in consultants, but at least the basics need to be there. I think a founder will be a successful founder only if he understands basics of everything: marketing, finance, accounting, all of it. If you understand the basics only, for everything advanced you will have help, but basics needs to be right.
Especially in that 0 to 1 when you can't hire outside experts.
Correct.
So some basic knowledge is required,
Correct.
right?
Correct.
And that's when I think you can leverage these free resources available,
Correct.
and maybe speak to few people.
Correct.
And you're also an author. So talk about that. How did you start on that journey?
So I was very intrigued very early on with this international accounting standards. So India had its own set of accounting standards, but there was international accounting standards, and India wanted to move to international accounting standards.
Hmm.
So I started learning way back in 2006 or 7 these international standards, and very few people were there and very few resources were there in India available at that point in time to learn international accounting standards. So I used to read the bare law, the bare standards,
Yeah.
and try and understand meanings of it. Then I started delivering sessions to small groups of chartered accountants, and from their questions I used to understand, what the standards are trying to say when they ask questions. And when you think back about those questions, you understand the real implications of those international accounting standards. That is how I used to learn, because I was pretty young at that time, had not much experience. Only way to learn was interacting with other people who are more experienced than me, uh, who understands transaction, but do not have this international accounting standards knowledge. So when you interact with them, when you debate
Yeah.
with them, you understand it better. So I started doing that, and then one fine day there was an author, who reached out to me for editing his book. So he had written the
Okay.
book. He wanted me to edit the book because I was delivering lectures, a lot of lectures. Somewhere he would have heard of me, and he requested me to edit the book. When I edited the book, I gave him a lot of suggestions, and he liked my suggestions so much. Normally, the editor is given acknowledgement somewhere. There's a acknowledgement page, and at the you write 1 or 2 pages of acknowledgement, and at the end you will acknowledge the editor.
Yeah. Yeah.
At the end, very small acknowledgement. But he liked my work so much that immediately after the cover page, the title page, that is where he acknowledged my work. So I got so encouraged that if I can give him so much suggestions and he liked my suggestions so much, why can't I make an attempt at writing? So I reached out to the same publisher, that that because publisher is always there. He has seen
Yeah.
my
Yeah.
editing, he has seen the
Manuscripts
suggestions. Yeah,
and
he's seen everything, right? Same publisher I reached out to, that have seen my work. Let me author a book, But he was hesitant. The publisher was hesitant because even if I author a good book, who will buy? Because people buy with the author name largely. So there would not be many buyers. So he asked me to find some good co-author, renowned co-author. Okay, I can become co-author and the renowned person can become author.
Yeah.
I was okay to do that. I reached out to a few renowned people, but they were not okay to lend their name. Okay, rightly so. Today, I would also not lend my name to someone unless I have actually seen the manuscript in detail and read and all that stuff, which I would not have much time to do. So, hence, I would not lend my name. Similarly, they did not lend their name to me. So, finally, I went back to publisher. See, I can write the book, I can give it to you, but I don't have any names.
Yeah.
That publisher took a risk on me finally, and the book sold off, luckily for me. So then I wrote another book and another book, and likewise I have written some 9 books. One interesting thing I'll tell you. I was meeting CFO of a bank, a big public sector bank.
Okay.
Okay, and for some work I visited him. I met him. It was a large cabin. Okay, he was sitting behind the table. I was sitting in front of him. Because of my age, entire discussion, it was kind of one-sided. I was trying to get him interested. He was not interested. Finally, I stood up and started walking, okay, towards the door of the cabin. Now, it was such a huge cabin that there were sofas on one side, there's table, and then there is near the door, there was a table, a rack. On that rack, I found my book. Okay. So I was just exiting and I just had a look at that book, which was my book. So I lifted that book and I said, "This is my book." And immediate reaction from that CFO was, "No, no, I have purchased it. This is my book." So then I had to clarify that, look at the author name. This is my name. He still did not believe it. Okay. He was looking at my visiting card. He was looking at the name on the book. And he tried comparing it 2-3 times. And at that point in time, in that version, I did not have my face printed on the book. Earlier, I was not so confident enough to print my face on the book. After that, I realized it is important to print a face also when you write about the author. When you need to print a face also on so that people can recognize you. So after that, I learned and I did that. But at that point in time, it did not have my face. So he was comparing the name. And then entire perception changed. The way he started interacting with me after that, he said he bought few more books and he gifted it to the board of that PSU bank. So yeah, that was a very interesting experience I had.
Yeah. And so all these books are on accounting standards.
Yes, all these books are on accounting standards. Some are the Indian, the old accounting standards, and some are on the international accounting standards.
Okay. So have you also explored other topics outside accounting?
See, I believe one should stick to the niche. Today, I believe if I want to, I can write a book on startups because I've experienced so much. But I don't think I can write on any other topic because you need very deep expertise in a topic to write a book. Otherwise, you're just playing to the fad. Like I said, you're just
Yeah.
playing to the tunes, which I don't want to. Unless I'm able to add value, I would not want to write a book.
And what is the process of your writing? How do you go about writing an accounting book? Because it's a very different subject.
Correct. So what I do is first I decide, who's the prospective reader of the book. Who
Okay.
would I want? So within accounting also there are students who want to write exam. Okay, so they want to learn from the exam perspective.
Yeah.
Then there are early adopters who want to do it for practical purposes, for implementation of accounting in their work, normal life. But they are early learners, so they want easy coverage, basics correct with examples. And then there are advanced learners who know the basics well. They'll get stuck in some complicated transaction and they will want that complicated transaction to be covered. So 3 sets. Okay. So in every topic you will find such. You just need to identify, you first need to segregate them and then identify which one you want to cater to. So I was catering to early adopters while my book was very popular among students also. But I wrote for early adopters, not for students. And explaining them the concepts from basics with examples, so that they can implement it at their normal, without covering very complicated transactions. At least the basics they should know. The normal transactions they should know accounting for. That was the objective. So first is identification of who you want to cater to. Second, what will they want to read? Not what I will want to give. Okay, what will they want to read? How will they want to read? Whether they want examples at the end or they want examples intertwined within the logics. So you write according to the readers. Okay. Now, how do I write then? After understanding who is my reader and what they would want to read, I would then write the universe of it. The topics. What would be the universe of that topic? So if I want to cover within accounting also a specific topic, say share-based payment, employee ESOPs.
Yeah.
What in that ESOPs would they want to know? All of it I would just put down.
Just
Okay.
like bullet points.
Bullet points. Within those bullet points, whatever research examples I can do, all that I will just feed in once, just put everything in. Once I feel that, okay, now everything is there in that Word file regarding that topic, then I would start creating a flow, a story, editing it, and bringing it in the form which I can then publish.
And usually, how long is this process from inception till publishing?
So, see, my books are roughly around 1,000-1,500 pages.
Wow.
Okay, so that takes a good 6 months to write. But to just cut it down, suppose I want to write a 10-pager article on one of the topics. If I am in good flow, okay, I can write it in say 2-3 days, a 10-pager, 15-pager article. So if I am in flow, that will happen. So all the chapters will happen very quickly. And I am someone who can get up very early in the morning. I'll get up at 4 or 5 and start writing, or I will sleep late in the night. I will keep working till 1, 2, 3. So if I am flow, I don't stop. I just continue because that flow is difficult to get.
Yeah.
And if I'm not in flow, then to bring it in flow, I might take a week. So, you call it writer's block kind of thing.
Yeah.
So it might take a week to come into that flow, but once in a flow, I can just, put all my day, night, everything into it and finish it.
Yeah. In entrepreneurship, also, usually it's in short sprints you achieve a lot.
Huh.
And then on some days it's going very slow, and then you're realizing things are not moving. And there are these patches of several days, and then suddenly in 1 hour you are able to connect dot and do multiple things.
Correct.
So great. And in this phase now around VentureEdu, I would like you to ask me some questions, maybe around what we are building, and then we can have a short chat around that.
Sure. So like I was saying, there's this gap which students, from student to becoming a experienced founder, they need handholding.
Right.
My understanding of VentureEdu is you're catering to this space, but I want to understand your objective of why did you. So normally when you see other VC firms or other investors, they don't think of education. They think of it as a business, investing and earning out of it. Why did you think of VentureEdu and what is your objective?
Correct. So, two things. One is the genesis, why this. So, whenever I used to meet early stage founders, maybe 2018-19 onwards, my first thought, whenever I listen to their journey, they will tell me this much we have raised, this is what we have done, was always that what if we could have this chat 2 years before, or maybe before you had already navigated all these different things, you have already, let's say, negotiated some SHA which is not making sense right now, or giving up some rights too early, or getting scattered, maybe trying 4 or 5 different things after raising money. So that has put you now in a desperate situation where you're looking for help, basically. Right? Although you have the capability, but it's just that you have strategically not thought about, okay, where are we going from here? What is my 5-year goal or quarterly or annual goal, etc., etc. So that was the genesis, that what if we can go further upstream and actually spend time with first time founders, probably 22 to 26, 27, and interact with them and see if they have an idea, they have a short thesis, and then can we work with them building that, right? And the whole thought was maybe we can improve the probability of success by 5-10%.
Correct.
Right? Otherwise, if someone is telling you that, guarantee, that's not there, because we have all seen in our lifetime people coming from top institution raising 200 $300 million
And still failing.
is still failing.
Correct.
So that doesn't guarantee. And having famous boards, advisory boards, and so many advisors, and it doesn't work like that. So so timing, execution, a lot of things have to align. Team has to align, and the market, etc. So the idea was that can we marginally improve the probability of success, and can we help them before they start this journey? So that was the genesis. And then
Okay.
second connection was that when I was in my very early in my university days, around 2007-8, I got into like a teaching assistant kind of things, and I used to enjoy that, working with people, younger people, helping them think through. Then when I was at BCG, I used to run onboarding for incoming analyst and associate, like day long session, let's say on corporate finance, right? So I used to enjoy those kind of sessions, just helping them think through case studies. This is the valuation methodology which BCG uses, let's say for total shareholder value, one of the framework which was very common at that time. So those two things I think just merged, and I thought this is what I want to do, and so far the journey is going good.
Very nice. Very nice.
Yeah, so that was the background. And again, the gap which we are trying to address is we want to give them that support system for those 14 months. And also, we want to fund the top ideas which are coming out of the program. At least top 25 to 30% is guaranteed funding. And then others also, we want to help them in raising fund. And not only this seed, pre-seed, but also till Series A, whatever. They can keep coming back to the mothership whenever they need support. So that's the platform. And it's a residential program. So they stay with us for 14 months. So they learn from each other also. And hence young founders, because once you are in your 30s, you can't really leave your family for 1.5, 2 years, right? So that's not practical.
Correct.
Yeah.
So I think a lot of MBA colleges are a hit because they are residential as compared to a lot of other education like CA.
Yeah.
It's not residential.
Yeah.
So you think this residential factor, because your course is also residential, so residential factor has a big play in one's education. More importantly, networking, and hence makes it much more successful than a normal course.
Yeah. And even if you look at our ancient education system, it was always residential, where people will come, leave their homes, stay in a place, right? Second, in all institutions in across the fields, you look at special forces, you look at other institutions, it's always about a group of people,
Correct,
who are going through the same experiences, probably sharing a lot of stories, learning from others' failures, and building that bond. And that bond probably stays for decades to come.
super.
So even if you look at MBA, right, what is the strength of, let's say, IIM Ahmedabad or IMC? Is not the exams, is not the faculty, is that the bond stays for, and it probably the real benefit kicks in after 10-15 years into your career, because that's when you actually start thinking, okay, who were my batchmates?
Correct.
Let me take out the list.
Where
and
have
let
they
me-
reached in
Yeah,
life?
where are they now? who is the CFO of so
Correct.
and so, and can I message him? Who is in Europe? Who is in North America?
Correct.
So that is the real benefit comes because now even when we look at investors in our networks, let's say IPV or other networks, I see so many of them leveraging that.
Correct.
And they probably have passed out around 2001, 2002, or even before that. But later in life, it becomes useful. But this one-to-many learning, right, that is very important. Even if you look at a traditional classroom, sometimes you are thinking about a question, but somebody else asks that question before you, right? So then you learn from that answer, plus you come up with your own follow-up.
Correct.
Right? Or you come up with a different question.
Correct.
Right? So this one-to-many learning and this shared experiences are important. And something happens, right? When you put a group of people together and ask them to work against a timeline. I think that multiplier effect, something builds in that. Even in group case studies in MBA
Correct.
classroom, other things, something happens. Late night discussions, working together, people coming from different fields.
Correct.
So that's the logic.
Correct. I think what I understand is also this will help, create a marriage of multiple founders to create
Yeah.
a startup in a way.
What my hypothesis is that out of 50, we'll probably have 20 ideas because some will merge
Correct.
once they come onto the campus,
Huh.
once they spend time together. So that's why in my mind, while discussing with team also, usually my hypothesis is that it's going to be around 20 ideas.
Huh.
It is not going to be 50 ideas because some people, when they start spending time together after first 2-3 months, they will probably like team up, or there'll be a lot of overlap. Or some people, let's say healthcare technology, some people will come together, or let's say let's
CTO
do
and CBO kind of thing.
let's do tech in health. So something like
Huh.
that will happen, and that happens. Yeah,
Correct.
that's
Correct.
something which I'm looking forward to. Yeah.
Very nice.
And the idea is also to bring together mentors like you, investors like you, who can probably not only help them at, let's say, a bite size, a module or something, but also bringing the practitioner's angle, right? So traditional MBA colleges are optimized for other goals, right? They cannot be optimized for investment and commercialization because their goals, the way they are structured, is very different, and that's also a very important role in the society.
Correct.
Right?
Correct.
Because the job market and the corporates, they need that kind of skills.
Correct.
But on the founder side, I think you really need, not the mainstream thinking. As you said, founder needs to know all the
Basics,
things,
yeah,
all the
absolutely.
pillars, and he also needs to be growth oriented, that
Correct.
I need to learn more about accounting or whatever. It may not be my topic, but I still need to learn, right? So that requires a different kind of touch. So that's the gap which we want to bridge.
Understood.
Yeah.
So all the best to you.
Yeah, thank you, and I'm looking forward to welcoming you.
Absolutely.
We are starting in April, so we'll be having you for more such sessions with the founders
Sure.
and practitioners as well. So thank you so much for coming through.